everybody. It's your girl Carmen. It is Wednesday, and Wednesday evenings we go live. It is about 8:46 p.m. Eastern, so I am a little bit late coming on. So I hope that you are passing by and you see me and you stop in to listen. But even if you don't listen, if you don't catch me live, because I don't intend to be long, you can catch the replay and just put hashtag replay in there or something like that. All right, please come and join me for this quick chat on I want to talk a little bit about when it is that you should review, some of your life circumstances, your finances, your life insurance. When should you review it? In previous streams that I had, I would talk about making sure that you meet with a financial counselor, meet with a financial services person, make sure that you are doing that every couple of years. Maybe at least once annually. But then there's some other times that we should really meet with a financial services person. I thought this was a good time to kind of bring that back. So because life changes, right? People grow up, they get married, they graduate college, they change jobs, they divorce, they retire, get grandchildren. So many things happen, right? The only constant that we can depend on is life changing. So one of some of the times that we should uh, meet with our financial services person to have a review. So marriage. It's awesome. I've seen so many of my people getting married on my timeline with such beautiful pictures. That's a very good time when you get married to have your life insurance reviewed. Now, listen, lots of times life insurance is something that we basically um, get and forget about, right? You either get it when you start your new job and then you forget about it, or you purchase it a couple of years ago and you're like, yes, task done, this is complete, and you get it off of your mind and you forget about it. But the act of taking a vow of getting married and coming together and starting and building a life together, sharing finances, especially if you decide to pool your money together to share accounts and things like that. That's a good time to review your policies to see if it adequately covers both you and your spouse, right? Because now it's not only you that you're worrying about. Although I think even if it's you should get it reviewed, every couple of years, at least once annually. But now that you've taken someone else, right, you want to make sure that they're going to be covered. Should something happen to you and they have to continue living, because that's the only thing that we know that happens, right? They would be able to continue to live that life that you guys envisioned, right? So when you get married, a couple of things that I want you to think about is to check to see if you have enough for both of you, for both spouses, and both of you need to be covered. Gone are those days when we, especially where I grew up, the man is bringing in the money or the bacon and this and that or whatever. Although I grew up in a single family home for a lot, so my mom was the person that was bringing in the bacon. But you want to make sure that both people are covered, right? Um, Another thing that you want to do is to make sure that you update beneficiaries. So even if you are both are covered, you might want to update beneficiaries, because if you're married, you may want to have your spouse. You may want to have your spouse to be that beneficiary. So you want to update beneficiaries, update if your beneficiary is a person, if your beneficiary is, if it's a business, if it's the business, if it's a trust that's going to receive that benefit proceeds, you want to update that so that whomever you really want to get your life insurance proceeds gets it, right? When you're alive, if you're using the living benefit, then of course you get it while you're alive to use while you are living, and that still protects your spouse, right? Because now there's just one income coming in, so you're still making sure your spouse is protected. Another thing to update when you get married is your retirement accounts, right? IRAs, Roths, any kind of workplace retirement plan that you might have, such as your 401k, your 403b, and TSP, and ABC, and DEF. You want to make sure that those things are all updated to make sure that the person that you want to inherit when something happens gets that. So, another life change, another time, divorce. Many people, if you've gone through a recent divorce or you're in the process of divorcing, you want to review your insurance policy and update those beneficiaries, because it's particularly important if you had an ex-spouse or that what you had listed as your insurance. If that is not changed, that money is going to go to them, and that might not necessarily what you wanted to happen. So you want to update after a divorce. So one marriage to a divorce. This right here is super important. I am talking to you. You just posted your home that you just purchased. You purchased a new home. Those homes are beautiful up and down my timeline. Although home sales have dipped a bit, people are still buying homes. So after a home purchase, or even if you're planning on purchasing a home and taking out a mortgage, that's a good time to take a look at your life insurance policy, because buying a home is a lot of times that's one of our biggest financial obligations. And so a life insurance policy can be the protection that you need for your to protect your home, right? That mortgage is a substantial debt that you will need to take care of. And if something should happen to you, it would be great if that can be paid off, so that at least have the ability to get it paid off by covering it. You got a couple of different ways to cover your mortgage. Most of the times people use a term life insurance policy for basically the term of the loan and the amount. That's pretty good, a good thing to do. Number one, it's inexpensive, right? Term life insurance is inexpensive, and many young families, especially when you have a home and you have children, term life does help. That's one part of your portfolio that you want to have. So term life insurance will pay off that debt. If you had a $500,000 home for 30 years, you could take out $500,000 to specifically protect that home. You'll have other insurance for other things, but you can have that specifically for that, or you can have more that includes that, right? Homeowners can buy that life insurance policy to protect that home. If something happens, that money comes directly to the beneficiary, so to your spouse, so that they can pay off that home, right? There's a couple other things that you could do. I don't recommend it, but you could get mortgage life insurance, which typically is an alternative to term life. It might be cheaper, but here's the thing. For that, it typically pays exactly what's the balance on the home. So if you had bought a $500,000 term policy to protect your home for 30 years and 10 years have gone, you still get $500,000 if something happens. But with the mortgage mortgage life that you get, that you can also purchase. That's something I used to do in my former life. I worked for an insurance company, and paying claims on mortgage life is something that I did. That money goes directly to the bank. There's no say-so. You don't get any say in doing that. That also, even though you're paying the same amount of money each month, it decreases as your mortgage decreases. So it pays exactly what is due to the bank, the exact mortgage balance, and it's paid directly to them. So you have no control. You don't want to do that. All right. But that's still another option. Of course, you could always have if you're permanent whole life insurance, and don't believe the hype of what people tell you that you shouldn't get that. Join us tomorrow night, where we're going to talk about some secrets that the wealthy do with their whole life insurance that you should be doing too. But if you have enough in there to cover your mortgage, that's another way of covering it. All right, number 4, having a child. So whether you're having your first bundle of joy, and it's really super awesome that I see a lot of my students that I taught in middle school, they're now married and now they're having their first or even second babies. I'm talking to you. This is a good time when you have, whether it's your first bundle of joy or your fifth bundle of joy, it's a good time for you to review your life insurance policy and make sure that you have enough to cover the expenses that a spouse may incur if something happens to you. And that's for either spouse, right? And that's why both people need to be covered, because if something happens to you, it's not just about your funeral expenses, but it's about the children, taking care of them from daycare all the way through college, right? If something happens to you and you were the caregiver at home, even though if you didn't have a job outside the home, you still need to be protected, because now somebody's going to have to be hired to do the things that you used to do, right? Whether it's cleaning, whether it's laundry, whether it's getting the kids ready for school, whether it's taking them to school, whatever it is, you will need to, it's a good time to make sure that you have a policy that is big enough to sustain um, that family until those kids grow up, right? If you have an employment change, that's another reason, another time to review your policy. A change in employment, you got a new job, right? A new promotion. These are also some good times, because now you're probably making more money. You need to up that coverage, or you're making less money. So this is a good time to also check it. Hey, this is something that people don't think about, but a change in health. Let's say your health changes for the better. You have been exercising over the past 2 years, you've lost weight, you've stopped smoking. This is a good time to review your policy and see if you can qualify for some better rate changes, right? You've lost all of that weight. Your risk is down. Your mortality risk is way down now. So it's a good time to do that, right? You've rectified any kind of medical issues that you were having problems with. On my timeline, it's people filled with they did the keto diet, and now they don't have diabetes anymore. They're not taking any of those medications. Good time to review your policy, see if you can get some better rates from what you had before. Good time to get one now if you didn't have one before, because right now you are in the best health. So you want to go ahead and do that, right? Another time, something, if you have to care for loved ones, like I have many single people would say, well, it's just me. What do I have to worry about, right? But do you have parents that you are the caregiver for? Are you taking care of somebody else's children? Are you the main caregiver or the main supporter of some of your family's children, your nieces, your nephews? You're the fabulous auntie that does whatever. Well, what happens if something happens to you? This is a good time to think about how you get coverage for those things, because now you're gone. Who does that? Who provides all of those things that you used to do before? And that's what your life insurance policy does. It just basically replaces or helps to keep up those pillars that you were keeping up, right? Retirement, right? You're getting ready to retire. It's a good time to review your policy. So that to make sure that you do have enough to last you through retirement, you do have enough, because many of us are living another 30 years after we retire, right? It's almost another working lifetime. So is my money going to last me all the way through retirement, right? Many seniors fear running out of money rather than dying. So this is a good time to do that. Another thing that I see, and you're probably not going to hear this with anybody, but this is a good time, right? It's new beginnings. Kids are going back to school. I see all those beautiful school uniforms, and little people are growing up. I'm like, what? I can't believe they're in middle school already. I can't believe it. My grandbabies, they are so grown. They're so grown. I have one that's going is a junior this year. He's going to the 11th grade. I have one that's starting middle school. Isn't that super awesome? I have one that's starting pre-K, pre-kindergarten. Isn't that super awesome? Even the littlest one is in she went to daycare, right? She started a little couple months ago or whatever, but she gets celebrated too. As a matter of fact, that's what I'm doing this Saturday. I'm celebrating with them that they finished the old year and they're moving on to the new year. So we're going to do some celebrations. If you guys catch me, or if your mom catch me, I'm giving gifts out for different things that I've picked out that you've done over the summer, during the year, and stuff like that. So anyway, this new school year time, it's a good time to review what you have or put in place what you don't have, right? These children are going back to school. It's a good time to start what is called an uninterrupted compounding account for them. Hint, hint, it's life insurance. But now you've created a savings account inside that life insurance for that child. Okay. Many people you're going to listen to, they'll say all these different names and they'll say all sorts of different things. I'm going to be clear and honest with you, right? But many of us did not know that we can put our money in a savings account. You're putting up money for your child for later on. You want to put that money inside of a life insurance account. There's so many things so many benefits for that, right? And you can put up $1 to $5 a day. If you want to put more, you can. But just let's think about it: $30 a day, right? I mean, $30, $1 a day is $30 a month. And if you're saving, that's $360 a year that you can put up for that child. And that is a permanent um, type of account that will grow, permanent life insurance policy that will grow, that will gain cash value, that will never lose any money in it. There's going to be a bit coming out for the cost of insurance, but hey, cost of insurance on children is pretty inexpensive. And so, but now everything that you put above the cost of insurance in that account is growing exponentially because it's getting uninterrupted compound interest. It can get 3, 5, 7, 11, depending on how it was set up and what plan that you got. But every time the stock market goes up, that child's account will go up and compound and be locked in, and they cannot lose even if the stock market goes down. Now your child has the bank of whatever his name is, Bank of Johnny, Bank of Timmy, Bank of whomever, especially if you're starting when they're 2 years old. You remember what I said, right? Start at 2 weeks old. The best time to start was 2 weeks old. The next best time is right now. So even if they're 2 or 6 or whatever, and you're putting in a couple of $100 in there, if you give your child $100 a month and you put in a savings account, that $100 next year is not worth $100 anymore, because it is, number one, you get in less than 0.25% interest on it, and number two, it's basically getting depleted because of inflation, right? Last year, the inflation was 9%. Typically, it's 3%. Hopefully, we get back around it. For the last 100 years, it would run in between around 2.97%. Right? So even that $100 back then was going to go down to $97, right? But now it's even less. You shouldn't, even if you say, I don't know what you're talking about, but these percentages and these inflations and stuff like that, you are feeling it at the supermarket, because your $20 that you used to go to the supermarket with, or your $50 that you went to the supermarket with, and you paid for your groceries, cannot do it anymore. Now you need 30. Right? Now you need $30 because it's like 9-10% inflation. Now you need $30 for that. Now instead of your gas that used to be 50, now you need 70 and $80 to fill up your tank. That's what inflation does. It eats away at your purchasing power. So if you put up $100 for your kid a month, next year, that $100 is going to be even less, unless you put it somewhere where you're hedging against inflation, right? And if you're hedging against inflation, even if you don't get as much as inflation um, will take away from your dollars. You'll get some more. You'll be beaten what you'll do at the bank. I told y'all the rich people don't put their money in the bank. So why should we? And I'm not anti-bank. Bank is used for all sorts of transactions, but not growing your money. Okay. So now is a good time that the kids are going back to school. If you do not have a plan on them, let's get a plan on them. Let's get a plan where you're putting away, even if it's $30 a month on them. Now, $30 is not enough to be paying for their college and things like that. But if you start where you can and do what you can do. So if you can afford more, you put more so that it will grow. And now that child can use that for if you have an emergency, if you have to get braces, you can take money from there, get the braces. And now instead of the same money that you were going to take to pay back the dental office at whatever percent interest, you can now pay it back to yourself. Right. And your money still stays there growing while you borrowed it to do that. You can borrow it for them when they get ready to start college, whether it's books, whether it's room and board, whether it's some tuition, whether it's what is left over after their scholarships paid, whatever it is, you can now do that. Whether they just want to start a business, right? So there's sometimes, the kid may want to start a business. He needs $3,000, $4,000, $5,000, but you don't have that. But because you were putting up a little bit, right? Now you can do that. But if you were putting that up in a bank, it would be nowhere near. In addition, all of us want to keep our children nice and safe, but these times we have to take all precautions that we can. Cover your children. Cover your children. It is so inexpensive. The other day I got a call from a parent of some young, they're a little bit more than teenagers, but she asked me about the cost. And when I told her about the cost of it, she gasped, like, what did you say? She could not believe the cost because it was so little. When we're talking about covering your teenagers, especially, they're 18 and over, they can get from 2 weeks old, they can get their own policy. But even 18 and over, now they can be covered with a term policy, and you cover them. All right. So that's what I wanted to talk about when you would review. And now's a good time to review as any. There's time to go back to school. Keep those pictures coming. I always give love for them. I love seeing them. Keep them coming and keep our children protected. If we say we love them, then we will protect them in all aspects. I have one question for you. Just one. What if your parent had done this for you? How would your life be different? How would your life have changed if your parent had set up one of these non-interrupting compound accounts for you? And now that you are, 18, or no, now that you are, when you were 18 or 20 or 22 or 24, and you needed to do something, you needed, $5,000 or $10,000 to start and chase your dream. You had it there because your parent chose to put up $30 a month for you in such an account. How would your life have been different? We can now do that for our children. Contact me. I'm here. I'm Carmen Bernard. You can reach me at carmen10k.com. Again, that's carmen10k.com. Thanks and have a wonderful evening. Bye-bye.